Ladies and gentlemen, welcome back to the channel. In this video, I will share with you why I think the markets are about to explode higher. I know a lot of people don't. They don't jive with this, okay? I think it is a big mistake if you do not hear out this video. A massive mistake. You're going to hear a clip in this video as well from 314 Research Warren Pice. Okay, this is someone like Tom Lee. He's been incredibly correct about the sell-off we were going to see in markets, although nobody knew how extreme it was going to be. He was calling for the sell-off when it happened almost perfectly down to the week. Okay, gave you about a month heads up, and then he called the recovery. Well, he says now you can actually model out that hedge funds and institutions are going to have to get reallocated into this market, that there's going to be a lot of buying pressure that has to take place over the next couple of months. Okay. And that, I think, from a tactical perspective is powerful. But the fundamental truth is the backdrop we have in markets is a lot better than 95% of people are actually talking about. See, the tax bill has spooked a lot of people in the bond market. Okay? They're only looking at one side of this. They're looking at debt to GDP ratios. They're only looking at the debt side. What if GDP actually accelerated? Wouldn't that be a crazy idea? Elon Musk actually says that is the only way we can save this country from bankruptcy. And that is what he's focused on. He actually says that robots are what's going to save this country. And I agree with him. Over the next 1 to 2 years, he says that fully autonomous ride-hailing services will show up in productivity and GDP data in a measurable way. He says that over the next 4 to 5 years, humanoid robots will show up in the GDP numbers, will start to really boost GDP and productivity over the next 4 to 5 years. I'll share what Elon said with you as well in this video and break all of this down in a little bit more depth. And let me give you the bottom line. I think markets are going to go 20% higher from now into year end. Okay? That is way crazier than anyone's expectations. But here on this channel, I strive to be as honest as possible with you. No matter how good or bad the prediction is, the thought process is around markets. I don't care if you're scared. I don't care if you are super excited by this. This is just the facts, and we're gonna put the facts together in an unbiased way in this video. So before we get to that, hit the like button as well as subscribe to the channel if you have not done so already. And I actually want to start this video off with this clip from Warren Pice, because he gives you a little bit of the technical backdrop, like hedge funds and institutions need to get reallocated into markets. He's not worried about inflation, so on and so forth. So take a listen to this, and we'll talk about it after.
Let's bring in 314 Research co-founder Warren Pice. Good to see you here. Welcome.
Yeah, thanks for having me.
So we're fundamentally, I think we have some questions, but technically we look all right?
Yeah, I mean, that's how we see it right now. When this whole tariff drama started, what we told our clients is basically you're not going to navigate this situation by psychoanalyzing Donald Trump. So, our view has been you're going to navigate this with technicals, what the price is telling you and the message of the markets. And the message of the markets is overwhelmingly bullish right now.
Why so?
Well, number one, the sentiment backdrop is institutions don't believe in this rally right now. So if you look at vol-targeted funds, CTAs, these systematic investors, they have not gotten back in on this rally. So that's the sentiment side. and institutions I talk to anecdotally share that opinion. And then technically, we've seen a lot of participation on this upside. Breadth, basically a combination of breadth thrust, which is a technical term for when a lot of stocks are going up at the same time, that we've really never seen and not had outstanding returns in the next year.
So you're saying at some point, because it's funny, what you're telling me anecdotally matches completely with what Adam Parker has told us in the last couple of days here on the set too, holding these dinners with institutional investors who are universally negative. What you're suggesting is at some point that money's going to flood into the market and take us higher.
Yeah, I mean, and you can model some of that out. And so that's what I do. You know, like at our firm, our clients are institutional, and there's a lot of skepticism around the rally for sure. That's what I hear anecdotally. So I hear what Adam's hearing. But when we look at things like vol target, so these are vol targeted funds is a very common way to manage risk, where they look at trailing vol and it caused them to de-risk during the sell-off in April. And now, when you just calculate that out, they're going to have to add a lot of equity back. So yeah, I think they're going to get forced back into this market.
What about rates? Do rates keep people out? Because,
yeah.
I mean, things can change, obviously.
Rates are that's the bear case, really, right? But I don't think that the fears in the bond market are overblown. And my honest opinion is that if you're going to fading fears in the bond market that are kind of existential, like we're going to lose the dollar's reserve currency and things like that, those are the kinds of fears that crop up at good buying opportunities. And so my view is that rates are basically stuck between two big forces, disinflationary cyclical forces. You have oil that's weak. Housing is kind of weak right here, no inflation from there, and then the labor market is softening. So that's disinflationary. I think the fiscal side is concerning, but I see rates being between 4.3, 4.6.
Oil had started to go back up, right? I mean, after it looked like it was going to steadily continue to go down, it actually had rebounded when we sort of figured out that, you know what, maybe the economy and the consumer is a little bit better and sturdier than we thought again.
Yeah, I mean, oil's trying to rally, but the problem we've seen, and this is my background, is crude oil.
Because we're above 61. I mean, it looked like we were heading, could be below 50.
Yeah, I mean, hopefully you can hold at 60, 61, but the problem, in my view, is that OPEC is adding so much supply back. So you were getting a double whammy. You got demand, and China has refused to fiscally stimulate their economy, even despite this tariff war. And so demand's kind of weak globally, even though the U.S. is okay. Mm-hmm. And then supply, you have OPEC just adding all this supply back. So, you know, to me, I think oil still has more downside than upside.
Even with the dollar even getting weaker, right? I mean, that's been a considerable story this year, too. The weakness in the dollar, right? Yeah. The inverse relationship between dollar down, crude up.
Yeah, absolutely. I mean, I think that relationship is a little overblown in the markets because we become such producers of crude oil to the United States, actually the largest producer in the world on certain metrics. And so when, you know, there's really this negative correlation is kind of broken down.
Now, before we get into this whole GDP, you know, debate, I think it's really a debate at this point because, you know, we don't know exactly what's going to happen. But again, the bond market is freaking out because the debt side is going to get worse and the GDP side presumably is not going to get stronger at an equal pace, right? That is why people are freaking out. That's why the bond market's freaking out, okay? Even the Fed Musa Liam says GDP is close to potential. The labor market is still around full employment and inflation is still above target. Even the Fed thinks that GDP is close to potential. Now, Elon Musk posted on X, he says, I have come to the perhaps obvious conclusion that accelerating GDP growth is essential. Doge has and will do great work to postpone the day of bankruptcy of America, but the profligacy of government means that only radical improvements in productivity can save our country. Okay. Somebody asked him, how soon can humanoid robots have an actual effect on the GDP of any country? Elon says 4 to 5 years. Robot cars, aka FSD, should have a noticeable effect in 1 to 2 years. So that's the kind of timeline we're looking at here. Over the next 5 years, you should see some pretty incredible growth in this country. I think a lot of that's going to be fueled by deregulation and a focus on AI. Okay, AI is not going anywhere. Okay, I think, again, this is like any new technology. We overestimate the potential near term, and we dramatically underestimate the potential long term. Okay, we overestimate near term, underestimate long term. This goes for literally any technology ever. This goes for cellular devices, okay? Back when you had a flip phone, okay, sliding keyboard, those days, nobody would have imagined you'd be able to, FaceTime anywhere, work from your phone, or blah, 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 blah. Like, the expectations were massively blown out from that, okay? AI is no different. Everyone is underestimating what this could look like longer term, especially when it comes to humanoid robots. That's like the holy grail. That is the ultimate productivity boost. That is what is really going to define our lifetimes, okay, is humanoid robots. When we look back 40, 50 years from now, we're going to say, wow, humanoids, we should have seen that coming from miles away. Okay? That's what it's going to be like, right? And the faster we understand this, can either get a part of it or figure out who's going to benefit from it, the better off we will be as investors from a financial perspective. Okay? That is the honest truth. There is no avoiding that. I don't think anyone in their logical mind would disagree with that, okay? But the fact of the matter is, these things may not be a 20, 30, 40 year kind of deal. We could see the benefits of this over just the next couple of years, okay? And Wall Street, as being a forward-looking mechanism, is going to price some of that in gradually. Over the next 6 months, I think we're going to price in what AI improvements could continue to look like. There was just news out today as well that Oracle is going to buy $40 billion, about 400,000 NVIDIA GB200 chips, right? Blackwell chips. This seems so obvious to me. It's like stupid, but Wall Street doesn't get it yet, right? So we're all focused on the debt side, but it's really the GDP side that we should be focused on right now. Who gives a crap about the debt? If the economy explodes, that's important. Now, think about it like this, okay? Very simple stuff here. The half of America, I would say, has been in a recession for about 3.5 years. A lot of these are tipped workers, gig workers, right? That just are not in a great place. If this tax bill really goes through the Senate, doesn't get changed as far as no tax on tips or no tax on overtime, you could potentially pull 60, 70, 80 million people out of a recession, give them 20% roughly more of their income to spend in the economy. That is massive. That is way bigger than anyone thinks. So while we're focused on the debt side, the effect on the economy could be massively positive from that. People don't save their money. What are we talking about? This isn't Japan. People spend all of their money. Okay, for better or for worse. They just do. That's the American way, as most people put it. Okay, so that is one area to be exceptionally bullish on. But the innovation in this country over the next couple of years, led by individuals like Elon Musk, is something you cannot ignore. Ignoring that will be your downfall longer term. Okay, and I think that's currently the downfall of a lot of people in markets. But the fact of the matter is, even the Fed doesn't understand this next part. Inflation is always a money printing phenomena. Okay? It is always when there is too much money printing done that gives you inflation. That can be amplified by, supply chain issues or so on and so forth, other things. But it's always at the basis principle a money printing phenomena. We're not there, okay? We're not printing our way to oblivion. We're not going to get this inflation that people expect. Now, even Trump says I don't want the consumer to pay the tariffs. Tariffs are helping, not hurting. Okay, if you're a company, if I was a company, okay, like Walmart, I would really not want to get on Trump's bad side. Call that for what it is, okay? You have 50% of the population, maybe more than that stands steadfast behind Trump. If you are a business, you really do not want to be blasted for raising prices and being on the wrong side of the Trump relationship. Okay? Again, call that for what it is. It's just the fact of the matter here. No company wants to be on the bad side of that. So even if you do have some pressures from tariffs, I think companies are going to really work to offset that in other areas. Again, that's bullish for AI. Could be not as good for the labor market. We'll have to, again, see. But with people having more money from the tax bill to spend, perhaps that just gets offset. There is still some open-ended questions here, but I don't think inflation is going to show up at all. Okay? I don't think we're going to have inflation. That's going to mean the economy is going to be in a good place over the next 6 months, in my view. We're not going to have inflation. The Fed will be able to cut rates a lot, which hopefully brings down long duration yields as we realize inflation's not coming back. Okay, inflation's dead, right? That's obviously going to help stocks a lot. I don't think this recession is coming without dramatic weakening in the labor market. With the way that tariffs are right now, especially on China, 30% tariff on China is still pretty extreme. But I believe that's going to get dropped down to 10% when the final deal is etched out. Because I think China is going to really crack down on fentanyl. Okay? I think that's the idea. And in that environment, that is much more doable for businesses. Okay? So I think even the tariff rates are ultimately going to be much lower. So again, not worried about inflation from that perspective. Now, I think one thing the Wall Street's really not even talking about right now is what opening up foreign markets could do to corporate earnings. Could that boost S&P EPS by $5, $10, $20 next year? You know, how could that impact be? Which doesn't sound like a lot if you just say it like that. But when the multiple is, 20, boosting S&P EPS by $5 could actually add $100 to the S&P, right? About $10 to the SPY. Again, if you boost that by $20 at a 20 times multiple, that could boost the SPX by $400. That could boost the SPY by $40. Add this on top of everything else, and it could be something that I think Wall Street is really underlooking and underappreciating at this point in time. So I envision over the next 6 months, you're not going to get inflation. The Fed's going to be able to cut rates. We're going to have deregulation because, again, the Trump administration knows with the tax bill that they have right now, they really need to count on the economy accelerating. I don't think they're going to do anything to jeopardize that. And I think, again, deregulation is one of those ways that you can get a lot of things done a lot faster. So no inflation. Fed's going to be able to cut. Deregulation, a continued focus on AI with broader foreign markets opening up to U.S. companies, all of which I would say are positive. I don't think we're going to have this recession, and Wall Street is severely underallocated in this market, as Warren Pice says. I think that this combination sets up a chase into year end, where we could get a 20% rally going here into the end of this year, which would put the S&P at about 700, because by the end of this year, we're going to be focusing on 2026. And even if half of these things come true, then I think, focusing on 2026, we're going to have, a much better backdrop. So again, let me know your thoughts on this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.